Hello everyone. We have been learning about portfolio management, implementation and review. And we have been learning about different measures to evaluate the portfolio performance. To evaluate the portfolio performance, we have learned about the Trenner's measure, the Sharpe measure and the M-square measure. For further information about these measures, please look at my previous videos where I have discussed these measures. Today we are going to learn about the Jensen's measure, which is also called as the Jensen's alpha. So the Jensen's measure, like the Trenner's measure, is based on capital asset pricing model. We have learned what is capital asset pricing model earlier. So the Jensen's measure basically reflects the difference between the return actually earned on a portfolio, the average return on the portfolio, and the expected return of the portfolio using its beta as per the capital asset pricing model. So we can say that Jensen's alpha is the difference between the actual average return on the portfolio and the expected return on the portfolio as per capital asset pricing model. So how do you evaluate a Jensen's measure? We should note that the value of alpha can be positive, can be zero, or can be negative. And it is said that a positive alpha is good. So when the portfolio provides a return higher than the expected return as per capital asset pricing model, the value of Jensen's alpha will be positive. When the portfolio provides a return exactly same as expected under capital asset pricing model, the value of Jensen's alpha is 0. When the portfolio provides a return lower than the expected return as per capital asset pricing model, the value of Jensen's alpha will be negative. So we have to consider a portfolio which has got a positive alpha. For ranking of portfolios on the basis of Jensen's alpha, we give first rank to the one having the highest Jensen's alpha and the last rank to the one having the lowest Jensen's alpha. We can say that if the Jensen's alpha is positive, a portfolio has outperformed. If it is 0, the portfolio has performed as expected. And if the Jensen's alpha is negative, the portfolio is said to have underperformed. We continue with the same example which we have employed earlier to discuss about the Trenner's measure, the Sharpe measure and the M-square measure. We have been given information about 3 portfolios, Fund A, Fund B, Fund C, and the return on market and the risk-free return for 9 periods. The mean return has been provided to you for each of the portfolios as well as for the market and the risk-free rate. The standard deviation for each of the portfolio as well as the market has been provided, and the beta for each of the portfolios as well as for the market is provided. Remember that the beta for a market portfolio will always be 1. So we need to calculate the Jensen's alpha. Let us look at Fund A. We need to know the average return on Fund A, which is 17.1. Now we need to calculate the return expected as per CAPM model. So the risk-free rate or the average risk-free rate is 8.6 here. The beta of the portfolio or the Fund A is 1.2. The difference between the market return and the risk-free rate. So the average market return is 11% and the risk-free rate, the average risk-free rate is 8.6%. So the difference between these two, which means the extra premium which the market has generated over the risk-free rate is 2.4. We multiply the portfolio beta to this extra premium generated by the market. We add up the risk-free rate to find out the expected return as per CAPM model for the particular portfolio. So now the difference, the actual average return and the expected return as per CAPM model is going to give you the fund alpha, which is 5.62%. In similar way, we can calculate for fund B and for fund C. If you notice, the alpha for market index is 0. It must be noted that the Jensen's alpha for the market portfolio will always be 0. This is because the beta factor of the market portfolio is 1. And if we put 1 as beta in the equation, we will get market return only. So hence the Jensen's alpha for the market portfolio will always be 0. So today we complete all the measures for evaluating the portfolio performance. See you for the next session. Bye bye.